Hi everyone, this is Falin, and in today's episode, we would like to provide an update on the China banks for this year. So as mentioned in previous episodes, the global financial sector was one of the best performing sectors in 2021, having rebounded by more than 20% on the back of a rosier economic outlook and higher interest rates. However, in stark contrast, you can see that China's Big Four banks recorded a loss of 5% during the same period. And amidst the global tightening cycle, PBOC is moving in the opposite direction. And in January this year, key lending rates were cut for the first time in almost 2 years to tackle an economic slowdown, dragged by a property market downturn and a strict zero-COVID policy. So the PBOC could continue easing in the first half of this year, leading to further rate cuts going forward. And against this backdrop, many investors have become concerned over the growth prospects and attractiveness of China's Big Four banks. However, just to provide some context first, trading at an average PB ratio of only 0.4 times and offering dividend yields of about 8%, we believe that China's Big Four banks remain attractive from a total return perspective. So we mentioned that the regulators' easing measures will be able to help stabilize the economy and help China's economic growth in 2022 within a reasonable range, which will in turn support the Chinese banks' loan growth. So in fact, the banks extended a record amount of new loans in January 2022, during which total new loans increased by 11.2% year-on-year. And it was also reported that most of the growth came from corporate loans. And what is interesting is that the surge in new corporate loans made in January 2022, specifically long-term corporate loans, marked the end of the contraction of the mid to long-term corporate loans that have lasted throughout the second half of last year. And of course, February 22nd data said otherwise, but growth in new loans went back to the positive territory in March. And while we remain cautious over the growth in new loans in the next couple of months, given the lockdowns across China's cities, we believe this could be a signal that Chinese companies' expectation of longer-term economic prospects is starting to improve thanks to the easing monetary policy. And looking ahead, we believe corporate loan demand will help to drive the overall loan growth of the banks. So we also believe the majority of the loan growth will come from the manufacturing and infrastructure sectors, which are the key areas of focus under China's 14th five-year plan. And one example is the semiconductor industry, where the government has continued to step up its support to promote the growth of the local semiconductor industry as the country strives to achieve self-sufficiency in chip production. During the same period, the Chinese government also announced that it has plans to build 30 new airports and thousands of kilometers of new railways and highways, all of which are expected to support growth in loan volumes. And besides, while China may be facing softening economic growth, it is still one of the fastest growing economies in the world. In fact, China is projecting its 2022 economic growth at 5.5%, which is above market participants' projection of 5%. And looking ahead, we are still expecting to see double-digit loan growth in the financial year 2022, which will be a key factor that should help to support the bank's net interest income despite pressured net interest margins. Next, while most banks in major regions were recovering from the COVID pandemic in 2021, China's Big Four banks have been busy fending off financial risk arising from the fall of large state-owned enterprises such as Huarong Asset Management, as well as real estate developers including Evergrande. So the banks, they had to bear the brunt of the restructuring of these companies, leading to a rise in bad debts that were reflected in increased loan loss provisions and non-performing loans made in the first half of 2021. Nonetheless, it is worth noting that they remain very well capitalized despite the challenges faced. According to the China Financial Stability Report 2021, which was released in September last year, the 30 large and medium-sized banks in China, which includes the Big Four banks, were still able to meet the capital adequacy requirements even under severely adverse economic conditions. So such severely adverse economic conditions include a surge in defaults, a fall in GDP growth, and etc. And taking reference from both the Huarong and Evergrande crisis, we believe the fact that the Chinese government is willing to let these companies go almost out of business is a reflection of the government's confidence that the banking industry is now strong enough to withstand the shock. And on top of that, a stabilizing economic growth thanks to the swift introduction of an easing monetary policy should also help to bolster the asset quality of the banks. Last but not least, capital return programs such as the dividend payouts, they form an important component of a bank investor's investment return. This is the same for the Chinese Big Four banks, as evident from the difference between total return and price return over the last 5 years, as shown in the first chart. One of the biggest reasons why we like the China Big Four banks is their attractive dividend yields. So investors will be thrilled to know that the dividends paid by the Big Four banks have been increasing consistently over the last couple of years while maintaining a payout ratio of only 30%. And coupled with rising profits each year, we believe that the low payout ratio indicates the dividend paid by the Big Four banks are sustainable. At current share prices, the Big Four banks are very attractive yield plays with an average estimated dividend yield of 7.9% per annum in the next 2 years. Looking ahead, we believe that the regulatory landscape in China will remain fluid given the fact that China is still undergoing rapid economic development. While this could cause certain levels of volatility within China's banking industry, we continue to favor the China Big Four banks, especially when they are trading at an average P/B ratio of only 0.4 times. We also continue to believe that China's Big Four banks will be one of the main beneficiaries as the country continues to grow and become the world's largest economy. With an average dividend yield of almost 8%, investors are also getting paid to wait for share prices to re-rate. Not to mention, the Big Four banks are also on a stronger footing with adequate buffers to better prepare themselves for potential challenges ahead. Therefore, we believe that Chinese Big Four banks, they are still an attractive space for investors who have the risk tolerance and the patience to wait for the re-rating opportunity. Investors can consider the China AMC Hong Kong Banks ETF with the ticker code 3143, which has an exposure of about 50% to the 4 banks. And with that, I've come to the end of this video. Thank you for watching this episode.